Welcome to this week's version of Nichols and Dimes, our weekly video series. The markets have been in some turmoil lately, as you very likely noted. If you look at your statements, you watch CNBC, and obviously you see what's going on. The markets have been selling off, particularly the NASDAQ, which is very tech heavy. Why? One of the main concerns and main reasons is because of rising interest rates. Now, obviously, if you don't know, the Nasdaq is primarily driven by technology companies, what we would term as high PE companies, and traditionally, those folks, those companies, don't like rising interest rate environments. Why? Because their cost to borrow, of course, goes up, which means that they're less profitable, or at least their cash flows get hurt. So we're seeing a lot of risk assets being sold off, and one of those assets is, for example, in the cryptocurrency space. You see a lot of the cryptos, for example, Bitcoin and Ethereum, and some of the others just taking a bloodbath, if you will. So, why are the risk assets selling off? Again, primarily because of rising rates. So, we're going to do a little history lesson to look at how rising rates have historically affected the equity markets. Now, this is just a historical look back. So, how has the S&P 500 over a long period of time performed in Federal Reserve rate hike cycles? Well, going back to 1950s, you can see the mid to late 1950s, the average annualized rate of return over that period of time was 13%. Fast forward a few years, in the mid to late 60s, generally a bit positive, even though certainly lot more modest. We had one negative couple year returns in the early to mid 70s. But basically, you can see the markets have generally reacted positively to rate hike cycles. Now, this does not mean that this will continue. Again, we're seeing a sell-off in the equity markets over the last few weeks. It's a risk-off trade at this point. Will it continue? No one knows. So I'm not suggesting that the past will equal the future. So be careful. So it's good to have this in your file manager, if you will, but this doesn't, again, mean that the past will equal the future. So you still must have, hedging mechanisms in place that, again, if the equity markets don't positively respond as they have in the past. So again, our suggestion is just look at this information, and I wanted to share it with you today because I do think it's important. Because why have equity markets generally responded positively to rising rates? Well, on some level, there's an assumption that if rates are going up, that means the economy can handle it, and therefore it's generally seen maybe as a positive sign. Now, all that to say is there's a very likely, very real likelihood that the equity markets have already priced in a rising rate environment. So just keep that in mind. And and I'm actually recording this video on Monday, and the market sold off, at least the Dow, around 1,000 points, and has since recovered. Now, I don't know how it's going to end today. I don't know. Of course, when you get this video on Thursday, I don't know, if the market will be up at that point. But my suspicion is, at least in the short term, we're very likely have seen, at least again, a short-term bottom. So if you're a client of ours, you know that we started hedging our portfolio back in September. Why? Because, as you may recall, if you've seen some of these videos in the past, we saw things back then that were very concerning, and they're still very concerning. What are some of the things? We saw margin debt was at an all-time high. Think about that. Generally speaking, the markets end up topping out when there's a lot of debt and leverage in the system. In addition, what we saw the number of stocks that are participating in the ascension or in the appreciation of an indices were getting less and less. Traditionally, when the amount of stocks that participate in the market appreciating starts falling off over time, that shows that the market breadth is contracting. That's not a good sign. So again, I'm just oversimplifying a few areas of the markets that we saw that were concerning, that gave us some high degree of caution. That's why we started reducing our exposure last September, again, to protect our clients' portfolios. Why? Because the number one goal in investing, in our opinion, is risk management, is preserving capital. The second goal, of course, is growing your portfolio. So again, I wanted to share some information with you today just to give you an idea how the markets have, specifically the S&P 500, has performed in rising rates and rising rate environments. Again, the past does it not necessarily equal the future, but sometimes, as you know, the past tends to rhyme with the future. So all that to say is make sure you keep your investment discipline in place. You have a well diversified portfolio that has hedging mechanisms in place. To that end, if you would like a second opinion on your portfolio, just to get a second opinion on what's going on, is your portfolio better positioned? What should you do now? Are there opportunities in the marketplace that you want to take advantage of? Send us an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more about what we do. Thanks again for watching, and I wish you a great day. Bye-bye.